Have you ever found yourself confused between investing in property or stock, unsure which path could lead to greater return on your investment? This video is for you. Hey guys, I am Rahim. Welcome back to my channel. If you're new here, smash the subscribe button because I talk about property investment, personal development, and how to gain financial freedom. I would like to thank everybody who subscribed to my channel. The channel is growing immensely. I thank you. For those who have not subscribed, I kindly ask you to smash that subscribe button and I promise to give you valuable content. In today's video, we're going to talk about the benefit and the differences between investing in the stock market and property investment, bringing the facts and historic evidence to guide your investment journey to ensure you're making the right sort of investment. So what is property investment? Property investment is the process by which an investor will buy a house and rent it out, whereas stock market is when an investor invests in the stock market for dividend growth and also capital appreciation. So if you're keen on making good money from investment, you've probably been thinking about the best ways to put together a mix of investment. Look, the big question may be for you, should you put your money in houses or stock? Here's the thing, both options can give you good profit and grow your money over time. But they are quite different when it comes to how much risk is involved in making the investment. And it is important for you to know and identify what the risk and advantages are for both asset class, which is what we're going to be talking about through this video. So, in simple terms, you've got two choices. You could buy houses, which is a bit safer and bring you a steady recurring income through the rent, and also it tends to go up in value over time. Or you could buy shares in companies which might jump up in value quicker, but can also be a bit more of a roller coaster and a bit more risky compared to property. So let's dive into learning the differences between stock and property and how we can take advantage. We will explore 5 key differences between shares and property to help you decide which investment strategy is best for your financial situation and your goals. So what are the 5 differences? So the first thing to look into is the risk and return for both asset class. Investing in property is often seen as a safer option than putting your money into shares. This is because the value of houses doesn't jump around as much as stock market does. But taking a bit more risk with shares can sometimes lead to bigger reward if the market's doing really well. Shares can give you quick profit when things are going really well, but those highs don't always last long, because the stock market can be very predictable and volatile, and you could stand a chance to lose all your investment. On the flip side, making money from property, like getting rent from tenant, gives that recurring income. Or if you decide to sell the house, you may be able to sell it for more than you've bought it. And it is more reliable over time, especially if you've bought a property in the UK, as it is stable and also reliable industry. Number 2, management. You see, once you buy shares, you haven't got that much to do. But owning a property means you will have to keep on top of things like repair and maintenance, dealing with tenants, and making sure the place isn't empty for too long, which can take up lots of time and money, especially if you haven't got a management agent to look after your property. But if you're experienced, you're able to hire a management agent who can handle all the repair and maintenance, all the issues with the property, so you don't have to. Plus, you've got that steady recurring income, and the value the property can add over time makes it a pretty tempting choice for putting your money in it, because it brings that steady recurring income and you've got the capital appreciation. Number 3, liquidity. Now this is important, especially if you need the money right now. You see, shares are highly liquid, meaning you can buy and sell quickly and get your money almost instantly, whereas property can take months to sell, but with the promising return in your long term, it will give you greater return on your investment. That's the reason why investors that are looking for steady cash flow choose investing in properties, because they have that steady recurring income that comes to them every single month, in essence, until they sell that property. So they keep getting that money all the time. Number 4, Diversification. Spreading your money between different types of investment like companies, stock, or houses in different areas can help you lower your risk significantly. If you put your cash into lots of different businesses or different places, you won't lose out as much. If, for example, one property did not work really well for you or another company did not perform well, you still got that sort of return on your investment. It is a bit like not putting all your egg in one basket. If one breaks, you've got plenty left in the basket. Look, however, if you're just starting out, I don't advise you to do both. Find one that works for you, that really gives you better return on your investment. Number 5, tax efficiency. Property investment provides valuable tax deductions. You're able to deduct your expenses, your mortgage interest, whereas dividend, you can still get tax advantages, but you've got capital gain tax to pay for. In a nutshell, both assets provide opportunity to build an asset portfolio tax efficiently, but it's important for you to understand what tax bracket you are in. In summary, putting your money in both houses and stock can be smart because it balances out the risk and possible reward to match what you want and your money's goal. Spreading your investment around has been shown to work very well over time. But if I had to start somewhere, I will go with property first, since it can give me a steady recurring income through the rental income, and the value of the property tends to go up over time significantly. Whereas when it comes to stock, I might or might not get my dividend, and companies may turn around and say, this time around there's no dividend to pay, or you are likely to lose most of your investment, or in some occasions all your investment. It is very risky and volatile for someone who's starting out. So if I was to start out now, I would rather start with property because one, I've got that recurring income coming in every single month. I have capital appreciation and it's an asset. I can walk past it, I can drive past it, I can visit it, and I can force the value left, right, and center. For example, I can go to that property today, add an extra bedroom, have a loft conversion, extend the garden. I can do so many stuff to manipulate the value of the property and also increase my rental income. So hence the reason why, if I was to start, I will choose property whole day long. If you like this video or any of my videos, hit the like button below, subscribe to my channel for more amazing videos. I look forward to sharing the next one.